Okay, so the recording is on. Thank you. Okay, so today the main topic is profiting from conditional order. Last time I explained how our trade system works and how the three targets work. We call it green, yellow, and red. So in this session, I'll explain how you can set your sell order based on the conditional order. So sell order based on conditional order. This is what I found. October is the dangerous month to speculate in stocks, and the other dangerous months are July, January, September, April, November, May, March, June, December, August, February, and it's by Mark Twain. So many years ago, Mark Twain said that, right? Now, this is another. So I like to read books, and then one of the books says, "You are thinking machine." So we are all thinking machine, but then we have to add, we are human thinking machine. So we are thinking machine, not like computer. We are human thinking machine. So when human is thinking, he's injecting his own decision, doesn't matter what. So his own biases, his own intuition. Uh, so we have to remember that when we are making a decision, we tend to make wrong decisions. Human brains are wired to make wrong decisions. So human brains are wired to make wrong decisions. And on top of that, when the bullets are flying, so when the bullets are flying, the things are looking hazy. Then our brain gets paralyzed and we tend to die. So trading is like that. The bullets are flying during the market hours and we get paralyzed because so much information is thrown at us. And on top of that, the phone is ringing, the email, the news, and flipping the channels and other business to take care of. So we cannot process the information correctly. It's just not possible. So very few traders make the decision, like uh, their decisions correctly without any involvement of pre-built logic or rules and formulas and algorithms. If they are pure discretionary trader, they are taking the decision based on just what they are seeing. They are very few. So I don't know how our grandpa traded before, like Jesse Livermore and others. I don't know. They traded from the beach. They just look at the quote on the wall and they made the decision. So we are not like that. We have computers to take advantage. So we are human thinking machine. So we have to remind ourselves we are human thinking machine. Now this is a question I read somewhere and I answered incorrectly. Can you answer this question? A bat and ball cost $10. The bat costs $1 more than the ball. How much does the ball cost? Can you type in the chat box here? You see the chat box? Can you type in the chat box the answer? No, a bat and ball cost $10. Says there's no depend. It's just the answer. The bat costs $1 more than the ball. How much does the ball cost? So it's a simple question. There is no depending, Larry. Larry, my friend. Okay, so please answer what you think. A bat and ball cost $10. The bat costs $1 more than the ball. How much does the ball cost? So it's a simple question. So let's see. How many people got it right? Let me see. And to be honest, I'm not saying I'm the genius one. I got it wrong too. But then I got corrected. So a bat and ball cost $10. The bat costs $1 more than the ball. How much does the ball cost? So all of you right now are thinking intuitively. You're thinking it's obvious. The answer is obvious, and that's it. We all are answering based on our intuition, and then we are not thinking beyond our intuition. The first answer came to our mind, and then we just answering it. So all of you wrote 10 cents, 10 cents, 10 cents, 10 cents, 10 cents, 10 cents, and only 1% wrote it correctly, I guess. He's thinking correctly. Let me see, who was that? I think. Let's see. So yeah, Raghavendra Kota. So he's the one who answered correctly. That is yes. It's only 5 cents. So now you can do the math. Bat and ball cost $10. The bat costs $1 more than the ball. How much does the ball cost? So the ball costs only 5 cents, not 10 cents. So if we cannot answer this simple question where you were given time and this question was sent in the email also. So how can you make the decision during the trading hours when thousands of data, you don't know the thousands of variables are being thrown at you. We just don't know. We don't think that way. And we cannot process more than 3 to 5 pieces of information at one time. So I wrote your bat and ball cost $10. The bat costs $1 more than the ball. So just do the little math, like three rows of bat and ball. So the total, you write down the total. The total will cost $10. So you write the bat, you write the ball in one row, bat, and then the ball, and then the total cost. So the total cost, we write $10. Maybe next time I explain in the slide. So 3 rows. One is for bat, one is for ball, and the total cost. So the total cost is $10. And write down the bat cost $1 more than the ball. And then the leftover figure will come to 5 cents. So the equation. So equations. So we cannot answer this simple question. So how can we make the right decision when, and on an urgent basis? So on urgent basis. So just something to think about. So during trading hours, if we have so many open positions. It's just not one. We have many positions open. There's so many variables are in the market. The market is moving. The positions are moving. So when the targets are there, some targets are hitting. Some targets are just right there. It hit, and we don't even know that it hit. So I'm sure you know that your target hit, and you don't even know during the market hour that it hit, unless you have a precise system to alert you. So you have to be very precise in setting up the target, and you have to be very attentive when the targets are hitting. You are acting, you are getting notified. So the target is hitting you, you set the target, maybe it hit and you just did not notice. Maybe you were walking the dog at that time. So in order to avoid all that problem, you can take advantage of conditional order. So before I explain to you conditional order, I'm sure you know, if you remember, you know the green target, yellow target, red target. Its first target is green, yellow is second target, red is the third target. So as the target is going down from green to red, the probability is decreasing because of the distance from the current price. So if the current price is 100, the target is 103 is green, 105 is yellow, and let's say 110 is red. So the distance is more. The longer the distance, the harder it is to predict the accuracy. So we provide the 3 targets, green, yellow, and red. We provide the 3 targets, the stock target. We don't provide you the option target. It's hard to predict the estimate the price of the option when the target will hit. You can only estimate. So there are formulas, there are calculators online. You can plug in the numbers like the strike, the number left in the expiry, how much you paid, what's the target, and then you will get some answer to the estimated option price. But you can miss it by 5 cents if you are just relying on that estimated option target. So let's say you bought a 10, you set it at $14.90. That was estimated. And $14.90 may hit, but it may hit as ask price. And $14.50 was the bid. So you miss so when you're calculating the targets based on the formula, you have to pay attention to the spread also. So that formula may be giving you the price at the ask, not at the bid. So you have to know what is the spread. So you minus it also from the calculated price, and that calculated price has to be very accurate, and it's only accurate when you have to calculate every day, I think. So in order to eliminate all that, we provide you the target, the stock target, and we are trading stocks, not we are using, we are trading options, but we are reading the charts of a stock. So we are not reading the chart of options. So we provide you the three targets, green, yellow, and red. And when the target hit, we provide you the alert. We have a different sets of alert, which we explained in the previous session. So if you cannot set the target, or you cannot act when the targets are hitting, you can set the conditional order. So the conditional order have several objectives. One is to eliminate greed, and another one is to enforce discipline. And the way we eliminate greed is this. When, let's say, you have a target of yellow, so you bought an option at 100 and the target yellow is 106. So when 106, the way the targets work magically is the attraction. So there is some attraction in that target. So the stock accelerates fast towards the target. You will, when the target is coming, the stock is moving fast towards the target. Most of the time it will happen like that, and you will think, okay, well, I will hold it. It's going beyond, so why would I sell? And that's where you see the target hit, and then the market pulls back, and then sometimes it doesn't come back to that target, or you wait for another day. And then even though when the target hits again next day, 1 or 2 days later, it's not the same in option. If for a stock, you will get the same dollar profit, but for option, you will not. You will get less. So, and you miss the opportunity of putting that money into another trade. So it's not working good. So unless you are taking action right away when the target is hitting and you have a precise system. So I have a real-time alerts. So I've set up the real-time alerts. So the moment I enter the trade, the targets are set right away, and I am being notified for the alerts. Any alert, green, yellow, red, and even before the green, yellow, and red. So you need to put some leeway in alert. Some 50 cents, 75 cents, depending on how big it is. So 50 cents is relative. So for 50 cents, if you, for a small price, is dollar is big amount. So maybe think about it in a percentage term. So some percentage before the target is hitting, you need to set alert. So you're alerted. So your exit protocol is triggering, and then you take action. So exit protocol triggering, and then you are monitoring it going down in the 3-minute chart level, and then you're taking the action. So it's hard. Now the human machine is working. So when you see the alert, the human is working, and the human thing that okay, I got this, I can handle it, and I will maximize the gain, and I'm expert in watching the trade. So if you're expert and trader, have skills, and you're monitoring the lower level frame, and you can make the right decision, fine. But if you're not, then especially when the greed is you know hitting you again and again. So you did it one time, then second time, the third time, then you beat yourself and say, why I do the same mistake again and again. And then you realize there's nothing wrong with your trade. It's just that when the target is hitting, you cancel the sell order. So I'm sure it happened. You cancel your sell order. I have done it many times, and I still do it. Cancel the sell order right there when the stock is there and hitting the target. Push the button, cancel, and then see that okay, I'll make more money. So over the long run, no. So if you have a discipline, if you have a way of understanding the target, then you can um, implement conditional order. So conditional order works better when the liquidity is there in the option, because it will trigger at the market price at that time. So if the option is not liquid and has a wide spread, you get the bad fill. So that's the drawback in conditional order. So one is to eliminate greed, and another one is to enforce discipline. So you just follow your system again and again and again. So there's no thinking involved. So I give you some example of Apple. So Apple is the favorite one. So I give you the example of Apple in both scenarios for calls and puts, and then you see if you can implement tomorrow. When you implement the conditional order, I learned this like 12, 13, 14 years ago on Interactive Brokers. So I was having this issue. Is there a way to access prior? Yeah, so it's on the YouTube channel. So if it's a free session, then it's available on YouTube channel. Just there are a lot of Trade Genie out there. So look for the real Trade Genie. So I rename my YouTube channel the real Trade Genie. Otherwise, I have a lot of homies and they all became Genie before, they just follow me and they have Genie name with the different variations of name of Genie. They spell with J, with they spell misspell and all that. So they trap you. So make sure you are on the right channel or you're not sending money via Instagram to them. So it's on YouTube channel called The Real Trading. And then if it's a paid class, then it's a paid, so it's not on YouTube channel. So I give you example of Apple bullish scenario. So let's say you are bullish on Apple. The current price is $150 and you estimated the target, let's say yellow target of 155. So there's a 5-point move you expect. So you bought July 150 call. Let's say we are in the month of May or June and you bought the July 150 calls. So, and you paid $3 for that. So you paid $3. Now you have option. Some traders have a predetermined objective. So there are various ways you can sell your holding. People use profit objective of 40%. People use dollar objective. People use time based plus dollar objective, market objective, market conditions, some event occurring, Friday coming, long weekend coming, Thanksgiving coming. So many criteria to exit. So one criteria is the 40%. Okay, he says like this: when it takes 40%, I get out. So if you have done your study that over the long run, your average is 40% and you're better off exiting at 40% and you nail it every time 40% and your trade hits. And the way you're finding the entry, there is a profit of 40% option in profit in 40%. So if that is the case, then you set the sell order at $4.20. So 40% of 3, then $4.20. So you set the $4.20 your sell order, and let's say the bid and ask is 20 cents. So when the ask is 440, your bid is 420, you get out. So if that's the way it works, it's fine. You can use this way. You can also, you are monitoring, you receive the alert from us that 155 hitting, yellow target hit, sell majority or sell half. So we send one of those two alerts, sell majority or sell half. So if you see some potential, then we tell you more potential, then we tell you sell half. If there's less potential left and the yellow target is hitting, we tell you to sell majority, or in case we have been holding that position for a while, so we don't want to hold anymore, so we send the alert sell majority or sell all. So let's say 155 hit, you got the alert and you sell your calls at 155. So you're monitoring the stock price. The third way is calculating option price based on a stock target. So every day you plug in your target price, you put the strike, you have to put some other values, how many days left, etc. And then the calculator will spit out the estimated price at the time when this Apple is hitting 155. So there are various ways of calculating. There are formula, Black-Scholes formula and binomial formulas for calculating the option prices. Mostly it's Black-Scholes formula. So a lot of variables behind, and then it gives you to set the sell order at 5. So you say, okay, I'll set the sell order at 5. Profit objective 40% is 420, but you say, okay, when the target hit, the price will be 5. So you have to calculate this option price on a daily basis. It's my belief. You have to, because the variables are changing. The variable which goes into Black-Scholes formula. So it's changing. So it could be 510, it could be 520. It depends how fast the stock is moving towards your target. If it's hitting right away in 1 or 2 days, then you may get 550, 560. If it's hitting after 10 days, you may not even get 420. You may get 4. So make sure you understand and calculate, and then you can set the sell order at 5. So there are 3 ways of doing it: when the target is hitting, or your profit objective, or you're calculating the option price. So you have 3 ways of calculating, and if it works, it's good for you. But we send this when the stock hits the target. So we send you the alert. And then when the stock is hitting the target, we do look at, we know, so I get the alert also, how much, what's the option price. So I look at it. So I know that because I look at my trading platform and I say, okay, it's hitting 155. This is the ask price. So this is the bid. So, and I know what's the percentage gain. So I send you that alert saying, okay, this is the percentage gain and this is the target. So you know that, and I know, and I record it. Let's say this is all happening, but you want to, so there's a flaws in this method. Profit objective of 40% may not hit. If you have a 40% profit objective, it may just go to 25 and then reverse it. So you may never get 40%, or it can go to 100% and you miss out. The option price based on target price cannot be accurate. So if you're calculating your option price based on target price, it cannot be accurate. So there is a flaw, and you have to be on high alert to calculate the correct price at any time, and then give some leeway for the spread and all that. And when you are, let's say you're not following these two methods, you're following the selling option when stock reaches target, requires monitoring and discipline. So this is very tough. Monitoring and discipline, who does that? It's very hard. Discipline especially, and then monitoring it when the target is hitting, you have to really go into the detail monitoring. So there are two kinds of monitoring: overview monitoring and detail monitoring. So for when the target is about to hit, you need to go deep down in a detail monitoring mode at a 3-minute chart, and you need to watch it at that time, what exactly that stock is doing. And there may be some other stocks hitting the target, especially if, let's say, if it is early morning, like first 30 minutes or 1 hour. So at that time, things are very hectic. So it requires monitoring and discipline. And discipline is you really need to sell it. Don't cancel your sell order. So if you have a sell order placed, or you need to be very disciplined. People tend to change their sell order. They cancel it. So what we need is remove our greed, enforce our discipline, and free up time to trade other stuff. So trade other stuff. So if you have, closing the position is more important than opening a new position or monitoring a new position. You can monitor it, but opening a new position when the existing positions are hitting the target, taking care of the existing portfolio is more than looking after something new where I can put the money. So one position is about to hit the target, one is about to hit the loss, and then we are worrying about opening a new position. So that's not the right way to do. The right way is to first take care of the open position, free up your time, and then you monitor the other trades. So free up by having, so we need to free up some time to open a new position, enforce discipline and greed. So benefits of conditional order. The conditional order is set and forget its strategy. So for liquid options where the spread is narrow and there's a liquidity, you can set the conditional order and let the market take you out. Conditional order removes greed. Conditional order enforces discipline. Conditional order allows us to take our dog for a walk. You can go for a walk, coffee, talk to your spouse. Let the market takes you out. So it's easy to get out when you're trading stock, but it's hard to get out when you're trading options. So by putting a conditional order, you free up your time. Conditional order puts money in our account automatically. So when you set the conditional order and your positions are getting close, sometime it will happen that your position disappears from your screen, and then you wonder what happened, where is my position? And then you go on your fill order, and then you see, okay, this one is closed, this one's closed. Sometimes you will regret and you will say, oh my God, I got the bad fill. So that will happen if you put the conditional order on illiquid stock or an options. So because your conditional order become a market order, and the market order is based on the last price. So if the option, if you're trading Apple and there's a narrow spread, then you will get the right price. But if you're trading something which has a $1 spread at that time, you will get bad stuff. So conditional order puts money in our account. I have members who they use this. I have a member who is a surgeon. So imagine a member who has a surgeon and he cannot trade like me and you watching all day long. So he sets the conditional order. So surgeon, if you are a surgeon, you can use conditional order. So maybe that's the criteria. So how conditional order works for calls. So I'll explain for calls and the same concept for puts. So conditional order says sell my Apple calls contract at market price when Apple stock price equal to or greater than 55. So in the brokerage platform, there is a sign called equal to and greater. So in other words, the Apple needs to trade at 155 or higher, then your sell order will become a market order. So it stays there, it becomes a market order, and then it gets executed at the last price or whatever is the price at that time. So equal to or greater. So for calls, it is equal to or greater. For puts, it is less than, equal to or less than. So if you are trading puts on Apple at the target, you will set the conditional order based on equal to or less than. So there is a I use TradeStation and even in Interactive Broker. So I'm sure the other platform also have the same condition. So just find it or call your broker. Equal to or greater, or less than, equal to or less than. So sell my Apple call contract at market price when Apple's stock price is equal to or greater than 55. So whatever is the option price at that time, it could be 420, it could be 5, it could be 490. So points to consider. So when you're setting the conditional order, maybe you try to set it on your simulation account a few times for calls and puts and see if it's working properly. Because if you set the conditional order wrong, you don't know the condition how you're setting up the order, you will immediately see your option get sold, and then you say, "What the happened?" So you don't want to say what the. So do it in simulation and see if it's working, and then you note down, and then you execute. So you don't want to say what the. So order is set at market, not at limit. So you cannot set at limits. Otherwise, what's the point of setting the conditional order? If you learn something new about the conditional order, the way it works in your platform, please send me an email. So please send me email. Any email, just hit reply and send if you learn something new on your platform. So the order is set at market, not at limit. Greater than and equal sign, greater than or equal to condition is set for calls. Less than or equal to condition is set for puts. And test with one contract. So you need to test first in the simulation account. And then when you're going in a real account, and if you have 10 contracts, don't set it for 10, you just set it for one. If damage is done for one contract, and you can maybe at the time. So the best time for you to set it up is when the target is about to hit. So if you are trading this scenario at 155, I would set it at when Apple is at 154, 60, 70, 80, and then watch carefully, and only one contract because you can only set for one. So watch it, it's about to hit, and then see what happened, monitor the option price, bid and ask, and see if it works. And then when it works, then you can set it up. So there's no problem. So do it in simulation first, then do in paper, do it when the about target is about to hit, do it with one contract, let it, so, and then you're expert. So setting conditional order for puts. So you're bearish on Apple, current price is 150. Let's say Apple is trading at 150, target price is 145, and you bought July 150 put, you paid $3. So now the target is on the lower side. So you will set the conditional order for put. Sell my Apple put contract at market price when Apple stock price is equal to or less than. So there is a sign equal to or less than. And for calls, equal to or greater. So when Apple hits 145, sell my contract. And you don't have to sell. So if three targets are given and you have three contracts, you can set one for this price, one for this, one for that. So you can do You don't have to sell all at one price. You can distribute your contracts. So conditional order means condition. So whatever is the condition. So you can sell Apple calls when Baidu hits a certain target. You can do that. You can buy Apple calls when Baidu hits something else. So it depends. So you have to put the symbol. So when you're setting the conditional order, you're putting the symbol that this, when sell this, when symbol this hits, do this. So you can do all kinds of things. So you can buy Apple calls when Baidu hits, if that is your logic. So sell my Apple put contract, but let's be very simple right now. Sell my Apple put contract at market when Apple stock price is equal to or less than 145. So again, so that's the conditional order. Again, I'm going back to the question. Brain is lazy. So brain is lazy. So remember, how many of you wrote the answer? And all, except one person, all wrote the wrong answer, 10 cents. Why? Because we took there are two parts of brain. So I will explain the two parts of brain. One, the scientists, they have named it uh, type 1 and type 2. So the people who use the answer, gave the answer for 10 cents, they use the type 1 brain, which is intuitive and which is lazy. The person, Raghavendra, he typed 5 cents. So he used type 2 brain. I'm just saying type 1, type 2. So it is actually, they named it type 1, type 2. So type 2 is logical, mathematical. It does the calculation. It takes the feedback from type. When the type 1 brain, which is intuitive brain, giving the answer, the type 2 says, okay, my intuitive brain is giving me this answer. Let me verify it. So he goes and verifies. That brain verifies and comes up with the answer, what the type 1 is telling, verify. So it's like a verifier. So if you answer 5, you use type 2 brain. If you answer 10 cents, you used type 1 brain, and you did not pass the ball to type 2 to verify. So I'm just saying, so we do this kind of mistake. We use intuition, and mostly the intuition is wrong. So people think I'm intuitive and making the right decision. Mostly they are doing wrong. So if you are intuitive and analytical, then you are creative. So if you're intuitive plus analytical, that equals creative. So we need to use both sides. So just give you the example. So the lazy brain answer was 10 cents. So the correct answer is 5 cents. All right. So this ends today's presentation. And next time I'll see you sometime midweek. I'm preparing another session. And I will send you the email. And I'll see you sometime in the midweek. And question, do you believe in trailing stops? Not for options. So I don't believe trailing stops for options. Unless you're trading something like Amazon, or not even Amazon now, something which is $1,000 stock, and you are up $5, $6, $7, $8 in the trade, and then you say, okay, I will set the trading stop in option, and most of the time, my opinion, that if you set the option trailing stop on the option, it's not worth it. And you will be stopped out, and then you will the answer will come, well, the trailing stop got me out, so it's not. So trailing stop works in stocks. So when a certain target hit, then you can set the trailing stop, or when the exit is hitting at the loss, then you can set the trailing stop. But for option, it doesn't work. The best, in my opinion, the best exit is getting notified at the target. So clearly estimating the target where you should be exiting, and only changing when you are sure that it needs to be changed, upgraded or downgraded, and then sell at that time. No trailing stop. Trailing stop, if it works, let me know for options. It doesn't work for me. 65. So for option trading, so It's very hard for option trading to set the stop at like 40% or 50%, because the stop will do its thing. The option will go down by 40-50%, you are out, and then it goes and hit the target. And sometimes it will not hit the target, it will expire. So options are meant for speculation and for hedging. So in option, you can lose 100% in that particular trade. You can lose 100% if you set that stop. So when we are trading, you can look at the trades I sent you recently. So you let's say for the puts, so set the target based on the recent high, maybe 6 days, 7 days, 8 days high. So set the stop based on the recent 6-7 days high. So you will see me sending you the stop based on the recent 6-7 days high. You can combine it based on the high plus the stop, the time stop. So you can do all that. But setting a percentage stop, 30%. I mean, 30%. You buy when you buy option, there's a spread immediately 5-10%. So if you put if you add another 20%, the stock goes slightly in against you, and there goes your stop, and then you're out. So it doesn't work. So for me, it doesn't work. For those who can day trade, so this is not day trading. So I am not a day trader. I am a so only the futures you can day trade. It's a hard day trading. I don't do day trading. For those who can day trade, which of your service, if any, who can put orders in the evening. So none of the service we have where you can put the orders in the evening. So I don't have the service. I don't send any alerts, etc. in the evening. I don't know how the people how they do it, because there is eternity from the evening till the market close. I mean, I don't know if I will be alive in the morning. So how can I send the trade saying that, okay, execute this trade in the morning at this price? I don't know. I cannot do it. So I'm sorry. Yeah, I cannot send the alert in the evening saying buy. Maybe I can send if there is a certain range, but not the exact price. So when we send out the alert, it's live in real time, right there at that time the price is valid. So I send you everything real time. Not I send you the updates, pre-market, after market, during market, etc. I have a team who is constantly updating me also, but not nighttime. I cannot send. So nighttime I do the homework, but I don't trade. So I just put my watch list. You need to talk to me when is a good time, Raghivendra. Anytime is a good time. My cell phone you have, that send me email, I can send you cell phone. Okay. When people call and I pick up, and then they say, how come you're picking up your phone on Sunday evening? You work? Yes. I don't mind picking up the phone. It's there, it rings. So I pick up. If I'm not sleeping, I talk. It's not, it's not like, okay, the phone is coming, let the other person handle it. Say the boss is not here. So I'm not like that. So just call me. The boss is always in the office unless he's sleeping. I don't know why people make that such a big deal, not picking up the phone. And where do you think the market should bottom? That's the $1 million question. So where do you think the market should bottom? So I have no idea where. If I know the answer where the market may bottom, I put everything on maybe QQQ. So I have no idea. Somebody wrote 3,300. So 3,300 on, maybe she's saying S&P. So I cannot tell. So this is another thing wrong with the trader. So I mean, you can estimate where the market may bottom. You can even estimate the date. So the date, I can tell you the estimated date is 30th of September. So you will say, okay, you told me 30th of September, before you told me 21st of September. So these dates are calculated. It doesn't mean that the market will bottom. So just a date. So you can, there are some methods of calculating the estimated date with the accuracy of 1 or 2 offset deviation or the interval. This is the turning date. So on turning date, the market, it doesn't mean the market will go up. The market may accelerate into that turning date. So 21st of September was the date, and the market accelerated to the downside. Now my next turning date is September 30th. So maybe at that time something happened. So what happens uh, when you know the turning date in advance? So you know, let's say you know that. So when you say, okay, I know the 30th of September is the date the market may stall, may start to turn its direction. So whatever is the direction, so if the direction is to downside, the market may start moving up or may start showing some sign of reversing to the other side. Then another thing which happen is the event. So event is the one which triggers this reversal. So what, then you go back and you say, okay, what event is occurring? So the 21st of September was known in advance. So now uh, the calculation did not know anything about FOMC or bank rate hike. So it so happened 21st of September, equinox or whatever, and then FOMC, and then the market accelerated to the downside. So the event is occurring, the turning date is known, the direction of the market is known. So the market may accelerate faster at that time or just bottom. And then you calculate the support level where you think. Now there are so the support. So now you're calculating only one market for the support, let's say S&P. So there are other markets, Nasdaq, Russell, Dow Jones. So you have to look at all the other markets. If another question, another point, if the reversal is about to occur, then look at the overnight futures market. Most of the time, when the date is known and the event is about to occur, the futures market tells you a big change overnight. So when that is happening, in the overnight, in the evening session, the futures are green. Let's say the market is down and the 30th of September is known in advance and the market is declining. Then on the night of 29th, then you say, okay, on the night of 29, what is happening in the futures market? If it's green, 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 then you are on alert that I need to pay attention to the morning. So now if you have a position open and they are puts or the short side, and this is occurring, the future market is up a big time, and you know the date, and there is some event occurring. So that tells you that you need to close your short positions or options, all positions. You need to close one by one, see what happened, and then start closing those positions. Should we go fishing until market goes up? Yes, the fishing pound is right there near you. Percent on each trade to invest. So yeah, so this is a very important question. The percent to invest in each trade. So now you have to ask yourself: are you a gunslinger? Are you a conservative trader? Is it a option portfolio? Is it a stock portfolio? Is it a retirement portfolio? So what kind of a portfolio you are trading? So and then where and how many open positions you have, etc. So 4% maybe 3% you're risking, or you are investing. You're risking 2%. Let's say you're risking 2%, meaning when the amount of dollar you invested in a trade, the amount of dollar you invested in the trade, and you know where the stop is. So I'm just talking to you in terms of shares, not in terms of options. So you know how much you're willing to lose. So I will explain to you in a separate session where this question comes up. So I'll prepare the slide and I will explain to you clearly in a mathematical format. So and just for today's explanation. So you know you are willing to lose, let's say $1,000. So $1,000, if you're willing to lose $1,000, then when you're entering in the trade, the stock doesn't know that you're willing to lose $1,000. So when you're entering in the trade, so you calculate your exit point. So you know where the exit is. So let's say you're shorting the stock, and the stock is the exit, the resistance is over there, up there. So you know when the resistance is conquered, I will lose this many points per share. So now per share you will lose this. So you come up with, you say, okay, if I lose per unit, I will lose this much, and the total amount I'm willing to lose is $1,000. So based on that, then you will know how many shares you can afford to buy, considering the amount you're investing. So amount you're investing, the exit you have, per unit the loss you will incur, that will tell you how much you need to put in the trade. So in other words, how much you're willing to lose and where you will lose. That will give you, if you plug in this number, I'll show you in next 1 or 2, 3 sessions later. If you plug in these numbers, you will get the answer. So this worksheet should be ready uh, with you all the time. So you plug in the numbers, how much you will lose per unit, the total dollar amount you are willing to lose. This is your portfolio size, so it will give you the answer right away. Your worksheet should give you the answer. And this, as your portfolio is going up and down, it's number of shares you're buying is increasing or decreasing, because the size of your portfolio is also playing the role. So the size of your portfolio, the dollar amount you are willing to lose. So the dollar amount you're willing to lose, the size of the portfolio. So you know all the time, you have this information all the time in on your hand, the portfolio size and the dollar amount you're willing to lose each trade. What you don't know when you're putting the trade, how much you will lose per unit, so per share. So once you know this much you will lose, you divide into the dollar amount you're willing to lose. So the answer will come to you that you need to buy these many shares. So sometimes you need to buy, you can, the answer may come you can buy only, let's say 110 shares. So if you can buy 110 shares, don't round it up to 200, round it down to 100. So this is another problem traders have. They round it up instead of rounding it down. So if the answer comes 110, don't buy 150, don't buy odd lots, round it down to 100 shares. So be conservative rather than going on the aggressive side. Some traders have a problem. They just buy 1,000 shares, everything, 1,000 shares of Apple and 1,000 shares of stock name Bed Bath and Beyond. So 1,000 shares here and 1,000 shares of Apple. There is no so if you make money in Apple, 1,000 shares, you'll make a lot of money. But if you lose, you will lose a lot. But if you make money in a Bed Bath and Beyond on 1,000 shares, you make tiny. But you can lose. So you have to consider the percentage also. People tend to forget the percentage also. So the percentage also plays a role. So percentage, dollar amount, the portfolio size, how much you're willing to risk, what else you have, the market condition. So this, the dollar amount you're willing to lose or the percentage is not fixed. It depends also on the market. So if the market is looking weaker, so you have open position in calls or long, and the market is looks like, I'm not sure, my open positions are not working, so I better cut down. So you need to cut down on your long exposure. So if you keep your percentage fixed, you just not being flexible. So that's another problem. Traders have a problem. They are not flexible. They just follow the same formula. They forget about the market condition. So depending on the market condition, you have to vary your percentage. Traders don't capitalize on the excellent opportunity. So ability to recognize that this is the excellent opportunity. So you can increase your exposure, but not gamble it. To a certain extent, you may want to increase your exposure in 1 or 2 trades because it's your judgment that it is going to work and I'm going to add. So scaling in. So you already invested 4% and now you're putting 1 more percent. But when you're putting 1 more percent, the stock is already traveling above. So you have some sort of raising the stop. So if you have not raised your stop on your existing unit and you are adding more, that is not right decision. So that's not the right decision. If you're not raising your stop on your existing unit and you're adding more to that unit, because uh, traders also have a problem in averaging it down. So just say, I just average down. So okay, so I asked, okay, so we bought original, we had a $5 option, and averaging it down at another one, two, three at $4.60. So what's the point? You increase your risk tremendously and made your average cost to $4.80. So you just increase. So originally you bought one contract at 5, now you loaded up with 2, 3 at 460. So your average went to 475, and then you increase your exposure. Now this position, when it loses, suddenly it loses big, and uh, the so your formula, the risk management formula, goes down the tube. So when you're averaging it down, you average down properly, that you have some edge. Averaging it down based on, not just for the sake of averaging it down. Average down when it's technically is telling you, the stock is telling you, not just based on the. If you have an option you bought at 5 and then you say, okay, it's trading at 10 cents, so what I will lose? Let's go buy 100 options. So maybe if that strategy worked 10 cents and you see the rebound, you originally you had 5 contract and then you 10 cents, you bought 100. So now forget about that 5. It's a brand new trade you executed at 10 cents. So that's the way we need to consider it. It's a brand new trade. You bought 100 contracts at 10 cents. Forget about that $5 option you had before. So that is not working. Sometimes we have to average down, not average down in the same strike, same month. We need to go into another strike, another month. So consider it as a new trade. You are already in the trade, and then you say, okay, if I were not in the trade, I was not in the trade, is this trade a new trade? I would enter. So I have this, let's say, re-entry. So enter or re-entry strategy. I say, okay, if I did not have a trade open, this trade I would have, and I would enter. So if you enter, then would you enter in the option which is 2 weeks left in expiry or 3 weeks left, or would you buy 50 days or 60 days in? So, and the original, the one you have, you bought it when the expiry was 50 days. So when you are holding it, and now it's only 2 weeks left. So if you had a formula for 50 days, and now you're adding the option where only 2 weeks left, so that's not the right way. You need to buy some another strike, and then the stock is down. So if the original strike was at 30 and now the stock is trading at 25, so if you add and 2 weeks left and you're adding more to the 30 strike and the same month which you had original, so you're putting good money after the bad money. So you need to buy 25 strike or 22.50 strike or 24, 23, whatever it is, 1 or 2 strike in the money, and then buy extra time. So now you have a brand new trade, and you may lose in the original one, or your objective now is not to lose in the original one. Maybe get out at break even or minimize it, and the dollar you will make from the new trade will compensate the loss in the previous trade. So you have to think like that. You don't mix it. You just don't say, okay, I'm gonna average down by 100, and then sometimes you get lucky, the stock goes up, 10 cents become $1, and you make a lot of money. I have some members who uh, I know, David. So his name David. He made millions. So he did all this, but the market has to cooperate also. So many variables. Uh, it should be in the money 30 to 60 days, right? So I usually buy. So when we are buying options, so this is another whole thing that. So I have prepared and I have another session, but I can explain. So 30-day is too tight. So if you're buying option 30 days, you know, like you are sure about the momentum. So momentum, people rely on momentum when they have nothing else to rely upon. So if you hear somebody saying, I'm a momentum trader, they are just saying that I don't know what I'm doing. I have nothing else to rely upon. I'm a Momo trader. So if you're a Momo trader, okay, if you expect, maybe the technically telling you the news is there and the momentum is there, okay, maybe, but totally relying on momentum is not good. It means if you are a momentum trader, you have nothing else to rely upon. So 30-day is too tight. Sometimes I do buy 30-day, but then I expect the stock to hit the target. So if you're buying 30 days time, you expect the stock to hit the target, because every day is just uh, losing value. So ideally 50 to 60 days and 1 or 2 strike. Also, when you're choosing the strike, um, so I have 2 methods of choosing the strike. So I'm just remembering right now. When I prepare the presentation, I'll write more methods. So one method is, let's say you're going long. So one method is to buy the strike, choose the strike which is near the support level. So if the stock is trading at 25 and you're going long and you see the support at 22, so I buy 22 strike. And the reason is, if I'm buying 22 strike and I know the support, so if the stock falls to the support, it will still be in the money or at the money. So it's not losing that much time value in that option. It's not losing that much time value. So if the stock is at 25, the target is 30, I buy 22 strike, the support is 22, and the 30 is the resistance level. So if the 30 is the resistance level, so I know that when the stock hits the 30 resistance level, I will be at the money and my option will be at the maximum value at that time, and I will exit. And on the other hand, support is 22. So if the stock goes down, pulls back, then it's 22. Whereas if I just think about, when you're putting on the trade, you first need to think, where is the exit? How much I'm gonna lose? Don't think about how much I'm going to make. First thing, okay, I'm putting this trade, how much I'm going to lose when it's not right, because that's the starting point. So if the stock is trading at 25 and the target is 30, and you say, okay, I am cheap, I'll buy 28 strike. So you go ahead, buy 28 strike, 3 points away from the current price, and then you wait and wait and wait and wait, and it goes to 27, then it comes down 26, then it goes 25, 24, 26, 27, and finally it hit 28. By then, so the stock is hitting the target 28, but your option is decimated, it's 60-70% down. So you chose the wrong, you were the winner. Your predictions, you can say, you see, I am so good in predicting the target. Yes, but you were wrong when you predicted the time. So you went wrong on the predicting the time. You were right predicting the target. So now what's the point when you're out of time? So anything, anytime, anything you're doing when the time is sold is hanging, that's a bad deal. So don't do that. Only buy 28 strike when you know it's going to hit fast. So if that is the case, momentum, then 28 strike will give you the better bang for your buck in the terms of percentage gain. And the 22 strike will not. 28 strike will be better. Or maybe you buy 30 strike because you say, okay, the event is coming. Let's say this is another scenario. The stock is, let's say the stock is trading at 25 and the event is about to come. So you predicted that the event is coming and the stock will gap up. So when it gaps up, I expect the gap at this price. So if you can estimate the gap price at this price, that's the strike you will buy, because when the event occurred, let's say earning. So when even so on earning in the stock, the earning, the stock can do anything. It's a coin toss. So unless you can read the chart correctly, even then it's still a coin toss. So if the stock is trading at 25 and you say, okay, this earning is coming tomorrow and options 2 weeks option left, I can buy at 50 cents, because if it hit 30 strike tomorrow, gap up, then I'll make this much, but I'm going to lose 50 cents. So if you are going to lose at 50 cents, people call it flyer. So if you're taking out the flyer, then that flyer will be burned to ground. So you can only, so people say, okay, I bought this 50 cents calls on this and now it's trading at 5 cents. Should I exit? So what should be my answer? You bought at 50 cents, now it's trading at 5 cents. Should I exit? I'm not sure. You lost already 95%. So why bother exiting? That's your, if you're paying to the broker, that's your commission. Why not just let it go 100? So when you were buying at 50 cents, you should know you can lose 100. So you're willing to lose 100%. There is no stop. So so that's why I hesitate in sending also the lower price option, like 80 cents, 90 cents. So if I send anything 80, 90 cents and it suddenly goes to 20 cents, and I start receiving emails and my team just start telling me, hey, we have this member is telling me, okay, 80 cents bought, now it's trading at 20 cents. What are we going to do? So I just avoid sending, because 80 cents can become 20 cents and then it can become $1.60. So so just don't send. I also don't send the trade which the options are. So I send the Netflix at $19. So when I send the option which is trading at $19, I send to the Netflix trade, but I didn't send to all services. I only send to the swing option, because the criteria is that you need to have a bigger portfolio. So let's say I send an alert for stock option trading at $2,000 Netflix. So the people who have a little portfolio, they also buy. They just say, okay, I have $5,000 portfolio. I bought one Netflix contract. It's $2,000 and I made $1,000. Thank you very much, Noshi. You made my day. My portfolio is up 20%. Just one day. I signed it today and my portfolio is up 20%. So then I said, okay, so this guy, he bought, he became my member today, and his portfolio is up 20%. So let me ask what he did. So I asked him, okay, so what did you do? How you made 20% in one day? Your portfolio went up. So he said, well, I have a portfolio of 5,000. I signed up last night. You sent me Netflix trade. I bought that one contract for $20. It's trading at 30. I am very happy for your excellent service and keep up the good work. So then I have to explain to him, sir, please don't do this mistake again. Don't buy. And I did not know you have 5,000 in your portfolio. You're in the wrong service. You're not even supposed to trade options. So please don't do. And then he said, why? Why I don't trade? And then after a few more trades, get caught, because that 5,000 became 6,000, and then 6,000 becomes 7, and then from 7 it goes to 3, and then 3 becomes 0, and then he is not happy with me. So you see the problem. So don't you only you know. So people send me emails saying, okay, you send me the trade, but you didn't tell me how many contract I need to buy. So what's up with this? So I really don't know your portfolio. I don't know who you are. I am Noshi. I don't know who you are. Are you Noshi? Do you have the same portfolio? If you have the same portfolio, I can tell you. If you know who I am, I can tell you how many contracts you need to buy and how many children I have and what I'm going through, what else I have open. If you know everything like me, I can tell you what to buy and how many contracts you need to buy. But only you know you. So you have to decide. So I can give you a rough guideline. So people don't understand all this, and then they trade and make mistakes. So I hope I answered. What is an in the money option better than out of the money option? Okay, Patricia. In the money option better than out of the, sometimes out of the money option better, in the money options sometimes better. So please Google, maybe I can explain next time. So Google in the money and out of the money. Can I have your contact number? Okay, I'll send you. You can send me. I can send you my number, and it will ring if I'm not sleeping. By the way, I send this every time, so you have my cell phone. All right, so I will see you midweek. I'm preparing something to teach you, and it's about your uh, trading biases, your mistakes, and how we make decisions, including me. So how we make decisions, what kind of biases we inject, what kind of framing we do uh, when we trade. So we have too many problems So I'll explain some of the problem. I'm working on that presentation and I'll teach you. All right. So thank you, and I go now. Thank you. See you later. Bye.